Good afternoon, everyone. Welcome to Hub 71 and this amazing WeWork office in Abu Dhabi. My name is Ellie Saffron, and I'm the Managing Director and founder of May Saffron, an advisory firm based here in the UAE, in Abu Dhabi. To give you a quick introduction on me, I have 20 years experience in equity investment. I've worked at Macquarie, I've run portfolios at ADIA, the Sovereign Wealth Fund, and I've been running the advisory firm that I have now for the last 8 years. I'm not an expert in VC, which is what we're focusing on today. However, Charlie Ill, our guest, the CIO of Investible, is an expert in VC. He has more than 10 years experience investing in early stage companies in the Middle East, in Asia, and in Australia. And he's the Chief Investment Officer of Investible. Investible is an early stage VC fund with offices in Singapore and in Sydney, Australia. They've reviewed over 13,000 startups and have been operating the last 10 years. One of their first investments was a seed stage investment in Canva. It's valued today at about $26 billion, and I'm sure you've all heard of it and probably use it. And they've made several other exciting and successful investments. So I'd like to introduce Charlie and thank him for coming here today.
Thanks for having me.
Welcome to Abu Dhabi.
Yeah, thank you.
And so who is Investible and why are you here, Charlie?
Well, so Investible is an early stage venture capital fund. We have offices in Singapore and Sydney as well. And part of what we do is currently invest in both broad scope investments as well as climate tech specific investments. And so that knowledge that we have generated over several years is something that we're actually bringing to this part of the world. And so we've partnered with Hub 71. We're actually currently and actively exploring new investments and startups in this region as well, but also looking to build out corridors between the markets where we currently compete or operate, which is Singapore and so Asia Pac, ASEAN and Oceania, and allowing that corridor here into the Middle East as well, and vice versa.
And how many funds does Investible currently have?
Yeah, so we've got four active funds currently at the moment. 3 of them are actually closed loop funds, and one of them is a co-investment syndicate. I think that's quite important in terms of the story of Investible. And we're in the midst of launching our 5th fund at the moment. So to add a little bit of color in terms of the model and what makes us unique is we have venture capital activity, which happens as you would expect a traditional VC fund. And then on the side, we actually have a sidecar co-investment syndicate group, which is a combination of people from our limited partnership. And so some of our limited partners get to invest alongside. And why that matters for entrepreneurs in the room is because these people provide our entrepreneurs and our portfolio companies with a tremendous amount of advice, access to revenue, access to new deals. And so they oftentimes invest in our businesses on top of the fund. And they carry on investing as the fund graduates into later stages, or as the companies graduate and the fund can no longer participate in follow-on rounds, that syndicate continues to invest alongside. So that means that for the entrepreneur, you get capital from start to finish.
Wow. So, and I think Investible was founded by 2 entrepreneurs. So it's an entrepreneurs fund for entrepreneurs, made by entrepreneurs, however, with an institutional process and framework.
Yeah, that's it.
How does Investible do it?
Yeah, so for us with Investible, I suppose our claim to fame is in the survivability of our companies. So not only do we perform in the top quartile for VCs in general, but our companies, if you look at the average failure rate of most startups, you're seeing that average failure rate with most VCs is traditionally around 50%. Whereas for us, ours is at 15%. And so a lot of that comes down to the products that we've developed, a lot of the process that we've built over the past decade of investing in early stage startups, and really transferring a lot of the knowledge that our 2 founders, Trevor and Creel, who were founders themselves at one point, but also phenomenal stock pickers, i.e. the investments in Canva, Ipsy, companies that have exited to Uber and other companies as well, translating a lot of that information into a data source and into a programmatic way so that we can systematically select great companies all the time.
And so what does a high survivability rate mean, and what does the 15% mean? How does that compare to other funds?
Yeah, so other funds, you're seeing about 50 to 60%, right? Depending on the resource that you read about. From beginning to end, it's about 50 to 60 will fail. For us, it's only 15, and the reason why it's 15 is, and the reason why that matters is because especially in markets today, and quite topical to the fact, to the economic market, right, as we, at this moment, there's a number of investors that are looking for that survivability as much as they're looking for that thrivability. Thrivability is your ability to go from 0 to 100, whereas survivability is being able to be resilient in the tougher times. And it's a common saying in the industry, and you guys know it as well, but great products never struggle, but that's not necessarily always true. And so there's a lot more elements involved in how we select companies to identify this is going to be a company that will have a high survivability rate no matter the market.
Okay, and so could you talk a little bit more about what those tools are that you look at?
Yeah.
To identify the high survivability rate? Sure.
So we break down a company into its 16 individual components, which and this is part of how we screen. So we screen 13,000 deals. We invest in approximately 1 out of 200 deals. So it's a very low hit rate in terms of companies that we actually invest in. And the way that we filter out these companies is through assigning data sources to the subjective parts of a company and then tracking that information over the last 10 years. So part of the advantage we have is, so the 2 data sources. The first one is called the Investibility Index. That's assigning 16 factors to the 16 components of a startup, an early stage startup. The second is really an over-index on the founder themselves. So because we are a business that was founded by founders, there's an over-index and an emphasis on the founding team. So there's a great tool we use called F4S, not to be confused with F6S, which is the marketplace for startups and accelerators. It's called F4S, and I encourage everyone here, if you are a founder or an investor, to look at this particular website, look at this particular tool. What this tool does is break down the founding teams across 48 motivations. So it's a psychometric test, essentially. And it's very different from what you've seen in the past, where you see, the Foursquare psychometric test. This is uniquely different because this was originally designed to see how a founder's motivations ties into the success of a business. And their core business, F4S's core business, is with entrepreneurs, successful entrepreneurs and unsuccessful ones, as well as corporations. And so those 48 motivations, plus the 16 data points of a company, plus the fact that we have 10 years worth of data and history to look back on to identify what combination of those qualities makes a company hunt, is really what allows us to ensure we have strong survivability for our portfolio companies.
Wow, okay. So you screen 13,000 companies, you have your 16-point checkpoint, you go through the psychometric tests.
Yep.
And you get to your sort of shortlist, I guess,
yeah.
and ultimately your portfolio, which is 1 in 200
right.
Investments. What if we lift the lid, the bonnet of the car? What does a winning startup look like, and what characteristics does a winning startup or a startup with survivability have?
That's a good question. So in short answer, it does vary depending on the sector in which they're competing, but largely across the founding teams, we found that there's certain qualities that truly stand out, and these are qualities that we always try and look for. In fact, I have this here to kind of help me with the notes on that one, so let me just pull that up. But I think what's most important, I think what's most important about the how we evaluate these businesses as well is how that sort of combination of founding teams. So if you have a team, so I'll speak generally while I find this particular file. When you have a founding team, what we look at, and if anyone can see it, what we look at is basically how the CTO, the CEO, and the COO or CIO or whomever it may be fits along the spectrum of these 48 motivations. Are there blind spots that the team particularly has, or are there strengths or mismatches in certain capabilities, right? So does the CEO have a certain quality that perhaps CEO should have, but he doesn't, or she doesn't? Or is the entire team far on the right-hand side and there's no one covering or balancing the opposite side of that spectrum? That's why there's 48 of these motivations. So ones that really stand out, level of desire to just start, frankly. So high in initiation is a particular quality that we look for with founders.
Yeah.
And it's, that's fairly self-explanatory, but the fact that we're able to actually measure that is a tremendous tool.
Yeah.
We look at, so we also look at a quality called automatic, and this is your ability to draw a conclusion on partial information.
Okay.
Right? And so what you find is that very successful teams are very high on the spectrum for that.
Yeah.
And so other ones may be related to external reference. Do founders go on it on their own, or do they prefer and rely on feedback from others around them, so advisors and mentors? And what we actually find there for founding teams is you need at least one person there. You still want someone that's going to drive the ship and in many ways ignore all the distractions that come their way.
Yeah.
But you also want someone else to be the ear. So if there's a team of 3, you want at least one person that is listening to the external references and being able to provide that input back into the core team. So it's those sorts of qualities that we've gathered data on ourselves, but this tool is also really tremendous and helpful at. And again, I encourage everyone to use it. It's a good tool.
Yeah, that's great. That's interesting. Yeah. I've met a lot of founders in my career that have companies that are ultimately, have grown and become a lot bigger. And the key characteristics that they all have that sort of in common are 2 of the things that you just said, with one extra one. But the first one is this blinker like focus. Yeah. Where, you could, if they say they're going to do something, they're going to do it, and no one's going to stop them. Yep. Yet it's combined with this amazing ability to make people feel really good about themselves and important. So bring the team together, bring people together, and take investors on the journey as well, I guess. So. Yeah, and I've just given you 3 of the 48 that are out there, right? Of the 48 that we do measure. And so, to your point exactly, there are the softer skills as well. So these are obviously the most obvious ones that I think I can share across the room, and people would I'd see nods in the audience and they would understand. But there's a lot of subtle ones that you wouldn't actually anticipate or expect that come out of this sort of analysis. And you sit there and go, that's interesting. In fact, that was a blind spot of ours. So much so that we ourselves, when we hire everyone within our team, we use this tool as well. Yeah. So we live and die by these tools, by assigning data to these companies and looking at the best combinations for the best companies. Yeah. And look, we are all nodding our head, and the things that you say do sound obvious, but it's quite unusual and unique to have such a refined process and automatic process almost that screens for this and produces a result without letting your sort of unconscious bias take over in meetings and whatnot. And VC is fraught with unconscious biases. It's just unbelievable how much there is that does exist. And so what I've shared with you is a very small sliver of our entire due diligence process. We have over 70 or so questions that we send out to companies. We integrate steps in our process to slow down the decision making so that you're not quick to react because of a first impression or because of a bias. The ways in which we manage our investment committee that in itself is quite unique
to how VCs traditionally work, because it's always about eliminating as much biases as possible.
Yeah.
Yeah.
Excellent. So, sort of looking at it from the fund manager or investor perspective, can anyone adopt these tools and this psychometric screening and testing to what they're currently doing?
Yeah, absolutely. So anyone is able to access these sort of tools, and that's, some of them. Some of them is proprietary to ourselves, but the F4S one is not. And that one you guys should. We're a major investor in that particular company, and so that's beneficial in itself from that close relationship, something that we've used since inception. And so the difference between us and someone else that adopts those tools is we have about 10 years worth of data that we can look back on. And that data is really important because it gives us glimpses into how teams shift and essentially evolve as a company evolves. The unique thing about this is founders at certain stages look different ways, and you want certain qualities to stand out at different stages of a company's life cycle. And so we've been able to measure that as companies mature from a seed stage where we invest. So we invest seed to Series A, approximately 500K to 1.5 million. And then watching how that company and the qualities of those teams, of high-performing teams, evolves as a company becomes much later. So when you get into later stages, things like governance and process and those qualities start to stand out more amongst the team. And so introducing those qualities into teams is oftentimes a priority and something that we constantly raise when we sit on boards and advise founders ourselves.
Yeah, it's really important. And it is, I think that's what we've seen a lot in the press as well, especially through that waterfall era of startups through 2020 to 2022 essentially, that how important governance, your board,
sure,
and all of that is. And it's hard to know when to focus on that and get it in, but I think the lessons we have now is that adopting it sooner than later is better for the survivability of your company.
That's
ultimately.
That's it. And what you're now getting into is kind of the other qualities outside of just numbers of what makes a founder or a startup successful. Right? So, a lot of what makes a startup successful post-investment is reliant on how well they get support and what types of investors they have on their cap table. And so this is where our model comes back. And I suppose this is part of the reason why I'm here speaking today, is to share what sort of things do we do to get that 15% failure rate so low. A lot of it also has to do with the amount of support that we provide these founders. And so because we have this co-investment syndicate on the side, that syndicate is predominantly high net worth individuals, family offices, a handful of institutions, but it's really individuals, most of it. We're tied to someone that is an individual. And so what that means is these guys are either super angels, they sit as LPs in other funds, or they themselves, own several businesses and are benefiting from certain technologies. These are the guys that actually come in and are the advisors to our portfolio companies. It's not, we don't have as much a high touch as our as this club. It's Club Investible, but our club members do. So that's how we're able to scale up. So we have 150 companies in our portfolio. We have 150 members. It's essentially one member per company today. We could easily triple it without losing that service of quality to our entrepreneurs, especially when it comes to portfolio management.
Great. Yeah. So we've got quite a few founders in the room today.
Yeah.
As an investor, can you tell us what does a successful founder do after a meeting, and what does a successful founder do after receiving investment?
So after the first meeting or so, I mean, during the due diligence process, or are you saying after the first investment?
Just after any first meeting, because a lot of startups here are they're starting the journey. They've just joined the cohort.
Right.
They're looking to get, they're going to be starting to have their first seed meetings, for example. So
yeah.
What's some advice that you have for them of what successful founders do following first meetings? They might not have even gotten through the process yet.
Yeah. Well, okay. So we actually, I was surprised today to come and see one of my former founders in a previous fund in the room. So borrowing from examples of what he did very successfully, follow-up is so critical. Absolutely so critical, because VCs are looking at, as shared earlier, we've seen 13,000 since 2018. We see approximately 400 a month. And being inundated with 400 today, that's with current numbers, being inundated with about 400 deals a month is a lot of distraction for the VC. And so constantly being present through follow-ups, emails, updates is actually a really great way to do that. And one of our founders was very successful in that. But what happens, I think what's most important is once you've received that money, that first 6 months is so critical to what's going to happen. It's going to set the tone for your next stage. So we raise capital, or founders raise capital today to get to that next level, similar to a video game. And so raising that capital and that first 6 months of activity, which is hiring the right people, setting the right strategy, making sure you focus on just the main thing. So we heard yesterday in a talk that it was about the one metric that matters. Yeah, that's important. But why that matters, or why that's important, is because it's the main thing. It's the thing that's going to drive your valuation up from where you are today to the next stage of investment. And validating that through customer service and interest. So I think really the most important thing for the founders is when you focus on that, once you've received that money, the next thing you do is go out and hire the right team using tools like what we have, taking advice from, and then building out the right boards, getting the right advisors around you. Now, theoretically, you have done that by now. Surrounded yourself with the right advisors before you came and asked for money. But that is part of it. Yeah.
So the UAE is hosting COP28 this year.
Yeah.
There's a huge focus and push on climate tech, energy transition, and a commitment to net zero.
That's it.
In the country. And you guys also have a similar focus.
Yes.
And strategy with your climate tech fund.
Correct.
I think you have an Australian climate tech fund with 24 investments earmarked, or 18 with 6.
18 signed, six to go from the IC. Yeah,
and
month.
a global climate tech fund.
Yep.
Could you talk a little bit about the sectors and what
Sure.
you're focusing on, and maybe a bit about what you're seeing as well coming through?
Yeah, that's fine. Look, I think climate tech's a really interesting topic. We're starting to see for the first time since, so in the early days of climate tech, there were waves and troughs, or peaks and troughs, when it came to the excitement around climate tech. Whereas more recently, we're not seeing that trough. It's actually sustainably stuck, and that's material because it now means that there is a real transition towards climate-friendly focused technologies. We essentially are closing about 4 companies a month, give or take. In terms of investments, and that really is dealing a lot with a backlog, but essentially what you said is correct. So we have 18 in the Australian fund or portfolio at the moment, 6 more awaiting transaction docs and signing, and we expect to close those this month, and then we start over again. So we're moving very rapidly in this space, and when it comes to key trends, I think what we're starting to find is that every sector is experiencing this as a problem, and this is probably something that a lot of folks who attend these events have heard often. But it is sincerely being felt by every organization. And as the regulators start to turn up the heat and make it harder for these corporations to operate without climate tech inputs, it's going to become more painful for their bottom lines. Therefore, the drive to innovate and transition is becoming more and more compelling, and it's allowing a lot of opportunities for businesses locally, investors, and entrepreneurs in that space.
Are you seeing a change in the quality of the climate tech companies
Yeah, we
through
are.
over the period?
Yes, absolutely. And it's similar to how you would see any new market for software as well, right? So the first companies that come out to a brand new entrepreneurship market is your typical classifieds, and then over time, those software companies then specialize into B2B and over time, and even specialized services to consumers. We're seeing it very similar when it comes to climate tech as well. So the first few companies that came off, in the early or 2010s and that sort of thing. They were kind of your run-of-the-mill sort of stuff, as you would expect. What we're now seeing is people become a lot more clever in how they apply climate tech. So the way we define climate tech is both direct and indirect reduction of emissions, but it's also assisting companies or individuals adapt to the new world that's going to be what happens after climate change. So there's a lot of adaptation that occurs as well. And I encourage entrepreneurs in this room to think that way with your own products. It may not necessarily be your core business, but if there's a piece or a way that you can support what is a climate tech strategy of a corporation or of a consumer, because consumer shifts are in that space as well, amplify it. Amplify it on your decks, amplify it in your presentations or on your websites as well. Let people know. Again, may not necessarily be what is core to your business, but if it does benefit the climate in any way, that will matter in the next 10 years. For investors, certainly.
That's good advice. I'll turn it over to the audience now. Would anyone like to ask a question? Yeah, I think there's some mics circulating.
Oh, here's one. I saw him just fine.
Yeah, just raise your hand so Joe can.
So I'm interested in understanding how you guys are specifically investing in which region for climate tech. And are you specifically looking at CCUS, carbon capture, utilization, storage, and what's your status for Investible on deep tech startups? Because those startups are sort of like the black sheep of the entire bunch.
Yeah.
Usually don't get the investment.
Yeah. Okay. Good. A lot of good questions there. So regions or geographies, global. Most of our investments to date have been out of Australia and Southeast Asia, and that's where most of our portfolio does come from today. But it doesn't preclude other parts of the world. In fact, that's part of the reason why we had this partnership in the first place. Second question was related to the what? The deep tech startups. Deep tech. Deep tech. Love deep tech, right? Deep tech is it's a great category if done well. So there are two types of deep tech. There's deep tech that delivers solutions to their clients, largely dependent on projects. Well, with the rise in interest rates and the cost of capital, it's very hard for corporations and their clients to run those projects. Then there's another deep tech, which is still patent backed, right? So it's still IP backed. It's still really smart, intelligent technology, but it doesn't necessarily depend on high CapEx from their client side to get it to run. And so this is more advanced materials. We see a lot of that, supremely scalable. We look at the manufacturability of that deep tech, and that's where the investors take that next step. And they say, okay, what are the unit economics? What's the bill of materials? How cheap is it to actually spin off more of that product off a manufacturing line? So that's the added layer of complexity that we look into when it comes to deep tech. That all said, software in climate tech is still the top performing category. And I envision will continue to be for some time. But deep tech is a close second, obviously, because that's the only other option you have. Okay.
Next question.
Hi. Just interested in the way you're using this F4S.
F4S, yeah.
Yep. And is it something that when you're having a look at an investment, you essentially do an analysis, say these are the holes, or yes, we're going to invest, no, we're not? Or is it something you say, fine, there are some holes here, go to the team and say, you need to plug these holes, and as a way forward?
Yeah.
And I guess the follow-on is, do you then, at some point in the future, reevaluate as the company grows, take another look,
Yeah, we do.
2 years down the track?
Yeah, so it's absolutely mandatory that every investment committee memo that we produce, this F4S score of the entire team, which shows the landscape of where all the individuals sit along the spectrum of each of these 48 motivations, is required. Excuse me, it's a non-negotiable. And so when there are holes, we as investors need to make a decision whether we're going into this one. But the bonus is we're going in eyes wide open, right? So we know exactly what we're in for if we do it. And because we have the profiles, we're able to then coach the founders, say, hey, did you know you had a blind spot in this space? Why don't we talk about ways to plug that gap? And what we will then do is take that information, go to our club network of 150 club members located globally, and we'll go try and find someone that can fill that gap and support those founders in that way. And those guys will sit in as an observer on a board, or there'll be a mentor or an advisor on the side. But oftentimes, those sort of combinations do work. The reason why I shared before that it is non-negotiable with investment committee memos is because when companies in our portfolio come back for follow-on funding, we do the F4S again. So we see how those teams evolved. And people evolve, right? In 6 months, even in a year, we've seen changes. Not necessarily drastic changes. People still tend to lean towards center of who they are. But we do see those changes occur. And when we do, it becomes an interesting sort of glimpse into, okay, well, this is where you are. This is where you now need to be. New criteria. Let's start talking about who else you need to support you. So, yeah, we do that.
Great. You've been patient.
Thank you first of all of the presentation.
Sure.
Just want to check in the AI space. How do you see the new startup with the AI? Like, how do you evaluate a company which has the same business model with AI technology and the same business model without AI technology? How do you evaluate your matrix based on that one?
Yeah, okay. So one of the things with Investible, we have investment committees every 2 weeks. So we have meetings every 2 weeks, and we decide on investing in companies every 2 weeks. So we have a very regular cadence. Why that matters is because we want to avoid getting caught up in too many hypes. AI is not one of those, let's be clear. But I suppose that's an important part of how we manage risk, to be able to then take a measured approach to every deal we see. So what's important to us from a valuation point of view is, in many cases, if we're leading the round, we will look at how that company is benchmarking through its comparisons and market comps and everything else. And because we've seen so many companies, 13,000, we're able to take a pretty good beat in terms of what looks expensive, what looks cheap. Okay, it's not a perfect science, that one. When we evaluate an AI company to a company outside AI, what we're looking for, what the big mover of that needle is the relative market size, more than anything else. The technology itself should be quite sophisticated. With the release of some of these AI tools that are out today, it's making it a lot harder for startups to necessarily stand out as unique, except when they incorporate the tools, because AI is not very good at very specific verticals, especially the modern stuff today. It's very good at mimicking a human and great when it comes to language, which helps companies break down barriers when they now automate the interaction with their customers. But there's still ways to go in terms of decision making and more narrowly focused as well. And so really what moves the needle on valuation would be market for us and how the clients are reacting. Yeah. Sure. If you're into the profit stage of things, yeah, we'll look at margins as well. But all that sort of stuff are just inputs, right? So we got the 16 on the investability index. We got 48 when it comes to F4S. We've got 70 questions we ask you. We do several customer reference calls. We do investor reference calls. We then look at and the investability index does incorporate a lot of what we're talking about: market size, profitability, margins. So there's a lot that goes into what we actually do. We have a score for affinity. Do we even want to work with the guy? We look at how well our companies can fit in with the expertise that we have on hand. There's lots of different things that we actually look into that informs us of A, whether we will invest, and B, what the price is of that company.
What about the weightage? Which one has the more weightage in the score itself?
The weightage,
repeat
yeah.
the question.
That's good. That's a great question. So the weightage will be dealt. So we do over-index on founders, and so those scores do stand out most, and it's essentially the first thing we look at. And then we go back into the investability score next. So we rely on those two first. Customer reference is also very important.
weightage, how are you gonna break it down? Like 15%?
If I had to break it down, if I had to give you a number?
Just rough number.
You're
Just to
tough.
get
All
an
right.
idea.
No, it's fine. So
Sorry,
look,
I'm
I would
coming
say
from the banking background.
no. That's
So
good. That's
that's
good.
why numbers important
Easy,
for me
easy.
to
Easy.
characterize the issue.
I would argue that probably on the founder side, 50%. So on the founder scores, which is that 48 motivations, that's probably 50% towards the total score of the company. Investability index, which factors in a lot of everything else, would represent another 25%. And then everything else, customer reference score, investor reference score, that sort of stuff comes in to fill up the rest of 25. Yeah. But 50, founders, massive. Yeah. Because at the end of the day, these teams are 5-6 people, and 3 of them are going to be founders. So, companies live and die by their founders.
Right.
Yeah.
Thank you.
Sure.
Do we have any other questions?
Thank you for your insightful talk.
Sure.
You mentioned multiple times your experience with data collected past 10 years. Yes, and then you derive some statistics out of this data. How these statistics derived from your market could be applicable for other market? That's the first question.
Good question.
And second question, advisory board. So when you found these gaps, so what kind of strategy you are suggesting to your founders to build this advisory board properly?
Okay. All right. 2 good questions. All right. So I'll start with the second one, which is the gaps. So it's in our ethos that it takes a village to raise a startup. Okay. And so that's where we rely on several club members to provide individual inputs into that startup to make them successful. We have mapped out our club members just like we mapped out our startups, just like we mapped out our staff. So we know the motivations, we know the strengths and weaknesses, but we also know who these people are, what jobs they've had, if they have jobs. Mostly they own businesses, but what businesses do they own? What sectors they're in? What are their key strengths, core strengths, right? That all is an input into who we're going to select to support our startups. So for example, we had a aviation company, we still have the aviation company, which does electric motors, right? This particular person needed someone that knows the industry well, because what we noticed there is that this is a founder, it's a mad scientist team, they're doing great. What they were lacking was a very structured sales approach to gaining access, right? And so what we introduced him to was a couple of our club members. One happens to be a very senior person in APAC working for Lufthansa. We had another one that was very senior working for Airbus. So these are some of the people that we introduced and said, look, you need to onboard one of them onto your board, and they're going to be able to provide you with inroads into the industry, because if there's an industry that's hard to penetrate, it's aviation. And so we look at all the qualities of that business. So it's not just about the founders themselves, it's where else are they weak on the investability index, right? Out of those 16 characteristics of the business, what are some pieces that we need to actually bolster, and how can we plug those gaps as well? And we don't get them all, right? We don't get them all. They still all look like different puzzle pieces once we've kind of worked it for the first 6 months. But we tend to do okay, right? 15% failure rate is excellent in this industry. Yeah.
Sorry, just use the microphone.
And second question about statistics, how can you apply your statistical model to other markets?
To new markets. Yeah, no, that's a good question as well. So where we have most of our data from is Southeast Asia and Australia today, because that's a large part of the companies that we've invested in. So those are ones where we collect most of the data from. We're starting to build that here as well, to see if there is any nuances to culture. Until we get that data, we're going to be depending on what we already have. And then as we build up, we'll be able to change the models, adjust the models, improve them based on cultural differences, if there are any. Sure.
And any last questions?
Get in with 2 questions here. Just on the advisory boards, where you have people on the advisory boards, typically they tend to have some sort of small equity component or whatever in moving forward. Is there a way you measure the value of the advisor to the founders or to the startup?
Yeah.
Going forward, because I think.
No, we do. So we measure as a team from a portfolio point of view. One of the things that is really important to us is how much revenue we've actually generated for our portfolio companies, and who within our friendly network has contributed to the increase in revenue. Because if people we know bring revenue to that particular business, that is an immediate uplift in valuation. So there's a direct reference from revenue to uplift in value.
So do the founders go in? Is there a discussion between the founders and the advisors on very specific input that is being expected from the advisor, or is it just more a general, like the aviation industry as an example?
No. It varies. It varies depending on the stage of the business. But if a business is currently churning and focusing on sales, then yeah, there's a very precise conversation that will happen between the advisor and the entrepreneur. And it's not, the other thing that I think is important to reference is why all this matters, why we're having this conversation, is because as you guys as entrepreneurs, it's really important to surround yourself with really successful people who can help uplift your business and take it to that next level, right? And I know that goes without saying, but investors aren't necessarily, or VCs aren't necessarily designed to do that for you, as much as if you have a syndicate on the side like we do. Because we have a syndicate on the side, and other investors have different things, like clubs, groups, whatever. If they have that on the side, that's really powerful. Not all VCs have this. And so the level of support that entrepreneurs will get does determine the potential success of that business. As a company approaches us, if they have certain weaknesses, let's say in sales, then yeah, the conversation is very precise about sales and sales targets and how this particular person is going to be able to help drive that sales, right, through the introductions they make, et cetera. We try as best we can to track all that type of information, because that's our pitch. When you go to the next founder, we say, hey, look, on average last year we were able to do a revenue uplift of approximately 30% across the whole portfolio, and of that, 15% was contributed by the advisors we installed in your business. So that sort of stuff does need to matter. Yeah. I'm showing you use numbers because those are the wrong numbers. But anyway, don't take those numbers as example.
Hi, Charlie.
Hey.
Great talk.
Thanks.
Two questions for me.
Sure.
First one, what's your appetite for health tech?
Health tech.
Yeah. And
Okay.
number two, I know you mentioned pre-seed investment. Yeah. Does that include, was that MVP plus traction or?
Right, these definitions, right? Unbelievable. Okay, health tech. We have, so our first two funds are agnostic, and in the agnostic side, we do have a health tech company.
Okay.
We look at largely health tech hardware, not necessarily the biotech. We try and stay away from biotech because we just don't have that expertise today. Something we want to build out, but that's down the track.
Okay.
Your second question again?
Pre-seed.
Pre-seed. What does pre-seed mean? Okay, so first off, we are predominantly seed and Series A investor. Okay, but this question comes up all the time. What does pre-seed mean?
Yeah.
So and seed as well. So seed is essentially the stage where you have early indications of product market fit, and what we're now going to do as a seed stage company is give you capital to really demonstrate that out. Okay.
Right.
So what that means is. I'm sorry, you a health tech company? Because I'll have to give it to you in the context of health tech. Okay, so health tech is probably very different than a lot of the others, right? That's more deep tech.
That's right.
So if you're seed stage in a deep tech company, what you're actually doing is rolling out a pilot, right? So you've got the pilot, you've locked it in, you're probably halfway through it with a potential customer, and what you're raising the capital to do is convert that customer, that piloting customer, into a commercial customer. That is the deep tech seed stage company. So if you walk backwards from there, pre-seed, you're probably got 5 or 6 people in the pipeline ready to lock in a pilot.
Right.
Okay. Now, when it comes to health tech in particular, you got complexities of FDA and that sort of thing, and I don't even dare try and comment on that because we only have one.
Okay.
But that company that we have is currently at their Series A and now just getting the FDA approval. So that's probably how you have to work backwards from there.
Okay.
But really, when it comes to deep tech, it needs to be in a pilot. What a pilot means is it needs to be in an operational environment. It needs to be able to demonstrate that it can function in that environment without a lot of mishaps. That's a successful pilot.
Okay.
And what I encourage you guys to do as founders is if you do get involved with pilots, make sure that there are very clear KPIs attached. If I am successful at this pilot, and this is what success means, you as a customer guarantee to purchase this many units. If you lock that in early, and it's hard to do, but if you can lock that in, you can go raise real capital on something like that.
Great advice.
Thank you.
Any other questions? Yep. We'll take two more.
Fairly recently with our company, we have seen where we are in a situation we don't want to raise funds too early, but think of it like purchase order financing, where we already have the customer and we need a couple of $1 billion to service them. Where do you guys play a part in that, or are you even interested in something like that? Because maybe in this could be a convertible debt note or something like that.
Yeah. Okay. So I will say specifically with Investible, no, we're in an equity investor, right? We will give you money to perhaps service a customer. Yeah, absolutely. We'll do that, no problem, right? But precisely in purchase order financing, what I can share as well, and I think this is perhaps a unique angle, and one of the reasons why I'm here as well is, and I haven't done any of this, I've done a pretty bad job of this, is tell you a little bit about what's going on in Australia and Southeast Asia as well. So the VC market in Australia right now has a lot of that capability to do some of that PO financing, right? So there is venture debt, and there's several players that are involved in venture debt. The same is true in Singapore as well. And that's perhaps how some of these investors would approach that type of arrangement. So much so that even the banks are getting involved at very early stage.
What I'm really trying to understand is if there's a startup which has this situation going on, would you be interested in them, regardless, maybe equity, convertible, whatever instrument you use? But if somebody has guaranteed customers on a PO and needs money.
Yeah, absolutely, we would.
Are their chances are higher than other startups?
Yes, definitely. And this is what I'm talking about when I said before, if you're going to do a pilot, it's important to make sure that you lock in a sales contract as part of that pilot. Because investors find so much more security in a company that says, look, I've got the contract, I now need the money to execute on that contract. And all they have to do is the due diligence on the product because they know that the revenue's coming in eventually. So that's a big one. Yeah, absolutely. So if a company has a contract and they need the capital to just deliver that service, yeah, we're all in. We look at it.
So for the business model, how do you evaluate the business model for the startup community as a whole, in terms of marketplaces or in different industry where you have the expertise in?
Yeah.
How do you evaluate if this is the right business model, it can sustain in the tough environment with the interest rates going up or down?
Yeah, okay. From a business model specifically. Yes. Okay. So business model, depending on all right, so the first thing we'll do is we'll look at the customer, we'll see how the customer is reacting to the particular business, we'll look at customer reference calls, investor calls as well, see what other investors are saying about that particular reliance on that particular business. The business model, the business model, as long as the business model needs to fit in with how their clients typically transact today. Or it needs to be something simple enough that if they are going to shift from, let's say it was leasing equipment to now it's a subscription agreement for equipment. I mean, it's a fairly simple adjustment from one to the other because they're going to translate whatever it is back in their own minds, right? So from a business model market fit, or it's actually more than that, it's actually model channel fit. We look at how the complexity of the product, the relative success of the channel, and essentially how you're going to charge. and how that fits within the broader market that you're trying to address. It's not a very good answer for you, and apologies. Yeah, so we'll look at model channel fit or channel model fit, and we'll also look at how that business model does embed itself into what has traditionally been done in that particular market. And to build on that as well, because we're in 2 markets, Southeast Asia has got some of the largest populations in the world, wonderful for consumer products. Australia has got a lot of businesses, and they pay high margins, and it's a great place for B2B. And so some of the complexity that we also have, which is an added element to it, is taking a product from one country and introducing it to another. So it's got to fit culturally, but also looking at, yeah, that worked in this country, but will it work in this one? Maybe not. So you need to adopt more of a hyper-local go-to-market strategy. Hyper-local being that you change your business model depending on the geography, customer segment, sector, et cetera.
Great. Well, I think that's time for us to wrap up, but Charlie will be around just after if anyone likes to come and say hello.
Yeah, pitch me your ideas.
Big thank you, Charlie, for your time. Let's give him a round of applause.
Thank you. Thanks very much.
And a special thank you also to Hub 71, and Joe and the team. They're amazing, and we're really lucky to get these
Absolutely.
opportunities.
Yeah.
So thank you.
Thank you.